Hey, Renter Retires, it's Matthew Seyoum here with another episode. And today we're here to talk more about Florida real estate with our good partner, Jim Sheils. Jim, how are you, sir?
Good, Matthew. Thanks for having me.
Yeah, absolutely. Thank you for taking the time. We're really excited about your inventory. When this episode goes live, your inventory will also be live with our renter retirement investors.
Excellent.
But we want to take it a step back. So we know that you do new construction. We were talking a little bit offline, which I told you I'm guilty of, about kind of your backstory. Can you give us maybe where you started, how long you've been in the real estate game, to where we're at now with new construction in Florida?
Yeah. Holy cow. I don't even like to say it, but 27 years ago, 27 years ago, I bought my first three-family fixer-upper in Lompoc, California,
Okay.
and renovated, raised the rents. And that was my conviction to quit my job because I was pretty young at the time and no one depended on me. So I went full gear into real estate investing in Central California for a number of years, buying, fixing, and reselling or renting foreclosures, and then moved to from California in '05 because the numbers were getting crazy. I didn't realize there was going to be an '08 meltdown as bad as there was, but California just didn't make sense. I didn't like the landlord laws, and I came to Florida, which had great landlord laws, better pricing, still could get warm and by the water, which I like for lifestyle, and continue to work here. And after the '08 meltdown, there was incredible opportunities here. And so, for myself, for investors we worked in a bulk foreclosures for a number of years till about 11 years ago. The deals weren't there anymore. And so we went, and my now partner came to me and said, "Hey, instead of fixing up old houses, what if we built new construction rentals?" And kind of the light bulb went off. It was not easy to get into, but it's definitely been a quite a different journey switching from old fixer uppers to new construction.
Interesting. Okay, let's stay there for a second because we have a lot of investors, and you've seen our inventory. You've worked with us
Oh
for
yeah.
now. We have rehabs that fit a
Yeah.
certain demographic of investors, and then we have new construction. And then on your side, right, there's even new construction multifamily, which is a whole different ballgame. But can you explain to maybe listeners what that transition looked like, or maybe the why behind it? I know for our investors, when you're looking at rehab, it might be an entry point thing, right? Or it
Yeah.
might be, hey, we're focused on cash flow and we're okay if we, relinquish a little bit of that appreciation. But what was your thought process in going from rehabs into new construction?
It was kind of a timing in my life where I wanted to be more effective and less busy. And for being someone that not only invested and bought properties, but worked with investors like, your community for a number of years, it came clear to me where I started in smaller, cheaper properties. That's a good entry point. And I still own both new construction and old fixer uppers, to be
Okay.
clear. And
Awesome.
both can make you money. For me, the switch, Matthew, was though, as I started to reflect, and so we're going back, 10, 11 years now when I went into new construction. So I'd already been full time almost 17 years.
Sure.
Uh, and I just looked back and I said, what would I tell that younger person? And the big lesson that kept coming up to me, because now I have, some of my older children are in their early 20s, just starting to invest, and I thought the big lesson for me would own less of better quality. That was it. That was it. And everyone has and I have friends who are the opposite. They say, no, I want to own way more doors with, and lower end of the property. And that's fine. Again, there's lots of formulas. The formula for me that worked to take down my time, take down the amount of turnover I had, the growth patterns. I just felt own less of better quality. And one of the reasons for me, and again, there's lots of different formulas. I look back how I had really created my wealth, gone from, near poverty to a good level of wealth. And I had made more money on long-term equity growth than I had on cash flow.
Really? That's big.
Yeah. And both are important. Don't get me wrong, both are important. But I found when I went into better quality properties, the cash flow may have started lower to begin with, absolutely. But if I had some patience, there was almost like this inversion where it would start to be it remained easier and rent started to go up and value seemed to climb better and stronger in these better properties. Where sometimes with my old fixer uppers that I had, I would start high, but then, even with doing new heating and cooling, roof, plumbing, kitchens, baths, my older houses, I just assessed for a larger maintenance, repairs, and turnover.
Yeah.
And so there would be growth. Don't get me wrong, and they create a lot of wealth for me, but it seemed easier to handle. The 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 better properties and that equity growth looking long term is where a lot of my net worth came from. And so I couldn't ignore that. And the cash flow began to catch up if you have patience. So for me, that formula that I was doing for myself and passed on to our investors, it just made sense.
Cool.
Yeah, so that was kind of it was just kind of a reflection period for me, Matthew, after 17 years in saying, okay, what really moves the needle and how busy do I want to be? I mean, I have 5 kids. I really wanted to spend time with them. Sometimes there were times my fixing old foreclosures up was profitable, but it bankrupted my time. And I didn't want to do that. And I know my investor base, well, they have less time than I do. They're running other businesses or have careers. Yeah, it was a big reflection point for me.
Real estate investors spend a lot of time looking for the next deal, but one thing often gets overlooked. It's how those properties are structured. Your structure can definitely impact how you are taxed and how much risk you're exposed to. Many investors choose to hold their properties inside of an LLC. Why? Because an LLC can help you separate personal assets from investment risks and create a clearer structure as your portfolio grows. Some questions investors often think about are: should each property have its own LLC? How do investors structure multiple properties? And what role does an LLC play in asset protection? As your portfolio grows, how your investments are structured can matter just as much as the next property you buy. If you'd like to learn more about how investors commonly structure those real estate entities, check out the link in the description below. Everyone says they're waiting until Q3 or Q4 to buy, but what if that's exactly when your first deal gets more expensive? Right now, buyers have leverage with price reductions, larger seller concessions, and the ability to aggressively buy down rates. Blueprint Home Loans is helping investors structure deals today that improve cash flow and set up their next acquisition, not just this one. Because real estate isn't about one good deal, it's about buying in a portfolio. Investors scaling right now aren't waiting. They're taking advantage of a temporary window. If you're ready to add your next door, let's talk strategy. Call us today at 888-343-1043 or go to blueprinthomeloans.com/rent-to-retirement. That's helpful. I mean, as far as the kids go, we're in different spots. I have 2 under 5, so I'm a lot closer to diapers than you are. But I tell my investors the same thing, right? When we're talking about, if you want to take the time, right, you can do everything that you and I are talking about. Anyone listening can do everything we're talking about if you have 10 hours a week or you have the risk assessment to get on the phones and do all of those things. The nice thing is, from what we're talking about here, I would take your 27 years or your 17 years in Florida specifically and kind of just be able to piggyback off of a deal that I know is going to work. Someone said this to me the other day, a fairway deal, right? We'd love home runs, but consistent fairway deals where
Yeah.
it's been vetted, we understand the market. Those things are really, really important, and especially when you're busy with family or professional lives, right? I love that. We've had conversations internally about our focus at rent to retirement being, secondary, tertiary markets. We're not really looking at downtown Miami, for example, right? That's not our bread and butter. So talk to that a little bit. I know that you're in a couple of different markets now. Again, live on renttoretirement.com. I saw Cape Coral with us. I saw Inverness. Am I pronouncing that correctly?
Inverness, which is part of the greater Ocala area.
Ocala area, which brings me to Ocala as well. Tell us a little bit about why for those markets in particular, what you're
Yeah,
seeing.
and it's I mean, and you guys teach these fundamentals well, so when people, again, being a guy from the Northeast that grew up in the Northeast, I've always loved coming down to Florida to see grandparents and stuff. But you thought all of Florida was Disney World, Orlando, Miami, and Tampa, and And that's where we just watch the numbers be the worst. They're emotional markets, and especially during the pandemic, lots of people coming here, and there's just not return there. But the secondary markets, like you said, we always look for 5 things, Matthew. I was taught by a mentor years ago. You don't want to depend on appreciation or growth, but if you can get in its way, try for it. And there were 5 factors that normally help you do that. Is there population growth? Is there economic growth? What's the affordability like? Because once things start to get out of affordability whack, well, growth can be questionable, and also cash flow is questionable. And then you also have desirability. Is there a draw living in the area, and healthy supply and demand? You don't obviously want to go where there's more houses than people. So we were always looking for that. And the secondary, tertiary markets, like you said, in Florida had them. And like, I guess we could focus in on Southwest Florida was really good in the beginning of the 2020s. Right now, we're seeing Central Florida kind of take that crown. So a lot of our building operations in single families and duplexes is the greater Ocala region. And the reason why, well, for 3 years in a row now, it's still the U-Haul number one destination arrival place. The number one leaving place is, I forget which town in California. It might be LA County. But then the number one destination spot is there. The median price of a home is still in the 270s, which is very affordable compared to, a Miami or a Tampa, which would be at least 2x that. The average family income is over 70,000. These are the things we look for. And it's beautiful horse country for people that want to live out there. They have their own economy. That's out where the Villages is just south of there, which is the number 2 and growing retirement community in the US. So it's positioned well. And that's our job. That's what we have to look for. Remember, we're putting our money on the line. We're buying the lands, we're developing it, we're building the properties on our dime. We're then, we have a financing program to get our investors in as low as 3.5% long-term rates. And so we gotta believe in the area. And so we're not looking for popular or sexy. We're looking for durable and fundamentals.
I love that. I love that. We talk about it all the time, right? This is not a get rich quick scheme. When someone calls rent to retirement, they're going to learn really quickly, hey, your first purchase is not going to put a Ferrari in the driveway. Right?
Yep.
It's just not. It's not the name of the game. Okay, that's really helpful. Now for everyone listening, just to kind of touch on one thing you said, the U-Haul metric. U-Haul, the actual moving company, puts out a metric. I believe it's once a year or twice a year.
I think it's once a year.
Just once a year, and they do a big pull of all their internal data and say, hey, this is where the most people are moving from, and this is where the most people are moving to. And you would think it's just for fun, but real estate investors are the ones that first in line to see those numbers, right? To just see what migration patterns are looking like in the United States. That's awesome. So then let's maybe jump over for just a second back to you specifically, Jim. What have you seen? Because the pushback we get as far as Texas and Florida, those are the 2 big players. Texas is kind of the retreat for the West Coast, and it feels like Florida is that retreat for the East Coast, or that landing spot for the East Coast.
Yeah.
The biggest pushback we see, it's property taxes in Texas, homeowners insurance in Florida. The conversation I have, and I love when real veterans of the game like yourself get on here and kind of validate me selfishly. I think people assume we're selling them houses on the beach, on stilts, that you're going to have to get insured, right? But that's not always the thing. So can you speak to that a little bit? Because that's the biggest concern as far as Florida real estate.
I hear it all the time when I'm traveling. I call it coffee shop conversation. I say, oh yeah, I'm a real estate investor. I build property in Florida, and I could be anywhere, Toronto, California, Chicago, New York. Oh, I love Florida, but man, I wouldn't have a house there. You can't get insurance. I hear that all the time. And I kind of giggle. And I mean, we're talking 29 million people living here in very different properties, like you said, and saying that if you're living at the beach or, within a half mile of the beach and your house was built in the 50s, you're probably going to have some really high insurance. That's just the way it is. That's what's happened with it. There, insurance companies are all about risk assessment.
Yeah.
And we have found that for us, again, I always say, make sure you get an insurance quote before you buy a property, um, because it is so different. It's so different on how it's built, and the elevation of the land and the year it was built is a total hack. You have to understand this. 2004, Matthew, everything changed.
Yeah.
Government came in after Hurricane Charlie went through Punta Gorda, Florida, where we still build still, and there was a lot of damage. And they said, okay, from now on, we have to have a stronger structural design. And, you used to in Florida, it was kind of like the Wild West. You could build a house at 2 or 3 feet above sea level, above that. And that is not high for anyone knows.
Yeah, yeah, that's unbelievable.
Sitting pretty low. Well, today you gotta be building at 13, 14 feet above sea level. I mean, that is a major difference because hurricanes, the biggest damaging effect is flooding. Everyone thinks it's wind, it's actually flooding. So, like when the big hurricane hit in Southwest Florida a few years ago, we had no flooding on any of our properties because we're building at 13, 14 feet above sea level. And the reward for that is not only is a rental property continues to hold safely your tenant and cash flow and such, but your insurance is low. So let me give you an example. Insurance companies are about risk, and we have two carriers that have done thousands of policies for us. So right now, and I would use this in this coffee talk, like in Toronto, Canada. I'd say, well, look, they'd say, well, tell us your insurance. It must be thousands a month. I say, okay, to insure one of our average starter single family homes we build in, let's say, Ocala, Florida, is about $67 a month for full coverage. And people kind of drop and go, wait, no, for no. And I said, I can show you the quotes. And it's because they're all about, and a duplex might be about $105 a month for full coverage. Because new construction, you have to build at a higher ground level and you have to build today to a higher standard of stronger structural design.
Yeah.
So for us, that's why we stick to the new construction, and we know we can do two things for our people. We can get them our internal mortgages, which can go as low as 3.5%, and we can cut their insurance. That same property that might be a few blocks from us that was built in the 50s and is at lower level, yeah, their insurance might be 5x what ours is. And, that can eat into cash flow. Now, if you're getting in cheaper, you can play the numbers. But for me, it was just, I'd rather have the safer, stronger property. The lower insurance goes right to my bottom line.
Love that. I love that. Managing a dozen single-family rentals means managing a dozen roofs, HVAC systems, and separate tenant relationships. It's time for an upgrade to economies of scale. BAM Capital's multifamily offering pools investors, capital, and the rest of the requirement for premium apartment communities where operational costs are streamlined and managed entirely in-house. Trade the stress of actively landlording for sophisticated, streamlined asset management typically reserved for institutional level portfolios. Scale your real estate portfolio the strategic way. Explore passive multifamily ownership with BAM Capital at bamcapital.com/RTR. That's bamcapital.com/RTR. If you think property management is expensive, try mismanaging a rental. A vacancy that sits for 2 months, an eviction that could have been avoided, or a maintenance issue that turns into a 5-figure repair because no one caught it early. That's expensive. A good property manager isn't overhead. They're protection against small mistakes turning into big losses. And that's why a lot of investors use MYND. Unlike traditional property managers, MYND manages your rental like an investment. They track metrics that actually impact the bottom line, like occupancy, delinquency, and net promoter score. And they have the results to prove it. Go to mynd.co/RTR to see how MYND performs and unlock MYND's lowest pricing tier in 12 months of StepSup Pro for free. Because learning the hard way is always more expensive. As we were having the conversations and vetting out the current inventory you have live with us, it was really refreshing to see that, because we get those questions too, right? People look at our pro formas and they go, no, this is Florida. There's no way that this, and we go, hey, we're not just pulling these numbers out of thin air. We're actually getting these from the people that live there, that work there, that are from there, and then we vet those out as well, right? So I mean, just a live pull of the inventory you have on renttoretirement.com right now, 750, 930. I think the most expensive currently, I want to say it's 1200, but I think it's like 1150 annual. These are annual numbers, everybody,
And
not monthly. In
a lot
case
of people thought it was weekly from what I would hear rumors from New York.
yeah, yeah. And so that's incredible. And thank you for speaking to that because structurally construction changes, right? That's the other part is we're not using the same tools as the 1940s either. And but some of those buildings are still standing and getting renovated every other year, right? So the new construction piece of that is really helpful. If we can pivot just a little bit, what are you seeing in terms of multifamily versus single family in those markets?
You
Talk to
know,
all.
w- we're still doing some quad developments in Jacksonville. Where we're still seeing a need. I think, I believe in the bedrock of the single family home, but we do quite a few duplexes, Matthew. Duplexes are one of my favorite stepping stones to wealth. The reason why, especially when we were building a new construction, I mean, I used to my first deals in California. I got a family home my first deal. I mean, I kind of jumped into the small multi right away by accident. So I've always liked them. But you're usually finding if you're looking for a duplex or something, it's built 50, 60 years ago easily. There wasn't a lot of new construction duplexes available. And so we said we need to build duplexes. That's a good thing. And what's great about them is they can be put in, we build on infill lots. And what that means, Matthew, we go into existing neighborhoods that have good balance of homeowners and renters to it. Normally we go for that 50-50, and the empty lots in there will buy up and will build a single family home or a duplex. So you can put a new construction duplex in a single family neighborhood. So it allows a tenant to move there that wants to live in that single family home neighborhood, but probably couldn't afford the single family, but now they're getting almost the feel of a single family, in their own yard, in their own garage in a lot of the cases, and they could afford it. And for you, the investor, you're bringing in two incomes now, and it produces a higher cash on cash return for what you're getting. And, I always look at exit strategy too. I have held some properties for 20 something years now, but there's also properties. If you decide to sell a duplex, I think you've got a great exit strategy where you can now sell to a house hacker. I mean, it's become mainstream where a retail buyer might step in 5, 10 years down the road and buy it from you to live in one side and rent the other, or you can sell it to another investor. So the duplex for me just is such a nice in between and kind of an entry level to multi-unit, but it also has the ability to sell very strongly to retail residential, if that makes sense.
Yeah. Yeah. That's amazing. Kind of piggybacking off of what you said with infill. I think it's really important for our listeners to understand there's full development, right? Where you're doing the developers doing horizontals and they're doing verticals, right? They are making the streets, the curbs, the street signs, and then they're making the buildings with all of it attached. Infill, it is dramatically different because you're taking those lots that are already in a developed neighborhood, but also the infrastructure around that neighborhood's developed, right?
Yeah,
Grocery store is where it is. The school is where it is. The jobs are where they are. And so a lot of that is helpful for the value to the tenant who now you have a line of people that do like that neighborhood, that
yeah,
do want the area, and you're doing that instead of maybe a traditional full development that might be 15, 20, 25 minutes outside a city center.
exactly.
Would you agree with that, Jim?
100%. And I'm glad you brought that up, Matthew. New construction rentals or even build to rent, which has become the term. I guess we were doing build to rent before the term even got
Yeah.
into the.
Yeah.
We
Yeah.
didn't realize what we were doing. And look, we build. A lot of people thought it was like you're building a whole neighborhood and making them rentals. And look, we do that. We build for some of the larger institutions and family offices. They will build a whole community of single families or duplexes, and townhouses, and they'll rent the whole community. That's a different play, and those are the big guys. They got deeper pockets, and they've got their own system and it's obviously working. For me, as always considering myself a small Main Street investor, I was always taught by my early real estate mentors, if you can get cash flow and go to an area that's not all rentals, but a mixture of homeowners and renters, that's normally a good segment of the market to be in. And so with infill lots, we can do that. You're not going into an all rental owned, investor owned neighborhood, because then I like, again, exit strategy. If it's all rentals, you probably won't be able to sell to a first time home buyer down the road if you decide to sell. So I like to get into those for this infill. So it's not like we're just building a whole community and you're buying one duplex in this whole community of rentals.
Yeah.
I think it's safer and better for us small investors where you're in a neighborhood where there's that protection of a lot of your neighbors are going to be pride of ownership, owner occupied. And so that's kind of the key thing I think about infill lots. That in fact, we really only do infill lots with our individual investors. The only time we do whole communities like that is if we're building quad communities. Because quad communities, look, a quad, you're an investor, you're probably going to on sell to an investor. You can do some house hacking with quads, but it's not as common as with duplexes. And we do have to build whole communities of quads because we do form HOAs for those. I'm not always a big fan of HOAs, but to keep the integrity of the neighborhood and it's safe and nice and upkeep, we will build quad communities with HOAs. And so those will be all investor owned. And that's why we do the HOA to keep the upkeep. But otherwise with the infills, I think it's just a really good margin of safety to be in a neighborhood where there's great pride of ownership already.
I love that. And just to back you up on what you mentioned about HOAs, look, I get it. I know the horror stories. You want to be able to paint the door you want, or you don't want to have to cut your grass to a specific ruler height. I get it. The difference, that is the concern or frustrations if you as the buyer were to live there. That's not what this is. For an investor, it's really nice to just have a second set of eyes and a second set of rules to make sure people aren't parking their pickup trucks in your front yard, right?
Exactly.
And so that's a huge part. So I'm kind of tying this up, and we'll let you go here, Jim, shortly. I appreciate again your time, but what would you say though in closing? What would you say to the investor? They have the capital, they have enough knowledge to actually jump. They're just sitting on the side of the pool, right? They're sitting on the sidewalk, and they haven't gotten in the game yet. What would you say to that person?
Yeah, the first real estate class I took in 1998 in Phoenix, Arizona. Great class, cost me $5,000 to go to. And that is still a lot of money. And I remain friends with some of the people there. And some I've fell out of touch with, but 10 years in, Matthew, after we spent $5,000 to go and learn to identify stuff that you guys are just providing. There was some groups like this 27 years ago. And in 10 years in, Matthew, they were still about to pull the trigger on their first deal. And by then I had done hundreds of deals in that first decade. Now I really went after it. I'm not saying you have to do that, but even the ones that took some, I mean, I have friends they're in Minneapolis. They bought maybe 8 properties and they're basically retired off of them now. You know what I mean? That was 27 years ago. They didn't want to go big. They had cleaning companies and other things, but they traded up into some nicer properties and such, but they didn't set the world on fire, but they took some action. These other people, you can't win if you're not in the game. And if you're waiting for that perfect pitch, for that one duplex that's just going to retire you, like I think you said, you're not going to get the Ferrari in the driveway from. It's not how it works. It's a building block thing. As you start to build, there's a snowball effect, a momentum, a second nature of understanding that you start in, but it does build. And I've experienced that, and it would, man, I couldn't imagine if I hadn't started, buying and taking that. There is a risk, but there's educated risk. And I encourage you, it's more dangerous to stay on the sideline than anything else. I've seen that firsthand.
That's amazing. Jim, thank you so much for your time. It's more dangerous to stay on the sideline than everything else. If there was a final word, that should absolutely be it. Jim, thank you again for taking the time to talk with us today. And thank you all out there for joining us to get yourself educated. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.